What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked #1 on Wall Street in the All-America Institutional Investor Research Survey.
Welcome back, Peter. It's good to have you back on the podcast. It's been a few months. I'm interested in getting an update on the thoughts of the consumer and the companies you coverage, which are largely hard lines and broad lines. I know you've been on the road speaking with clients. So what's the current sentiment? You've described it as the consumer is not weak, but they're selective. So we'd love to get your thoughts.
Thank you both for having me again. We cover hardline, broadline in general. A lot of it's in the housing complex, whether it's home improvement, furniture, mattresses, consumer electronics. We also cover on the broadline side some of the dollar stores and Walmart. So we cover kind of upper income, lower income, and big ticket. So when we look at first half of the year was really interesting. We had a little bit of momentum with the consumer space and consumer spending in January and February, and the Middle East really just caused the whole environment to do a 180, where consumer spending, because of all of the news headlines around rising gas prices, started to slow a little bit, and investor sentiment towards consumer space went completely negative. So it was really brutal for March and April. I guess you fast forward to today, I think what's interesting is we're getting a really good setup for the back half of the year. And if we dissect the last 6 months, you saw the K-shaped economy widen during the first half of the year, specifically around March and April, where the rising gas prices pressured lower income. Stock market as a whole did pretty well. So upper half of K just kept cranking. But what we see now is, I think on the low income side, things have started to improve. Investor sentiment's warming up to lower income names, spending back up, picking up. And then on a lot of this big ticket stuff, I think it's fascinating that it really didn't soften very much in the second quarter. So we do a mattress survey with about 15 retailers. They're independent. We do a furniture survey with about 12 retailers, combined into about 1,000 stores. And it was interesting. There was a little bit of softness in March and April. And then you come into May and June, and these highly discretionary items, big ticket, did quite well. And this not only against tougher year-on-year compares, but also as we were winding down on tax refunds. So it feels like the consumer's out spending. They're being selective, but where there's some innovation or where companies are staying in front of them with marketing, those companies are picking up a lot of shares. So we're pretty bullish on the back half of the year for certain pockets of our coverage.
Curious what you're hearing from investors regarding the conflict in the Middle East, because as you said, consumer stocks really had a great start to the year, and then most of the names, as they tend to be very correlated with what's going on in gasoline prices and interest rates, got hit with the onset of the war in late February. And then I believe in about the middle of May, the 10-year yield peaked. And that was after oil prices had come down sharply. And you saw about a 5 to 6 week period where the market was broadening out. Rates were coming down. I think they came down about 30 basis points on the 10-year, down to about 435. And everything seemed to go back to that broadening trade we started the year off. And then, of course, things started to heat up, and now oil prices are back up, and gasoline is doing the same, and the stocks are now starting to struggle a little bit. One of the things I hear from other analysts and investors is that many people are not so worried about the Middle East. They're frustrated that it's not really going away, but don't seem to be overly bearish. We're even hearing this from energy investors. Look at the price of oil. It's at WTI is at 82. It's not at 100 or 120. What are you hearing from investors that are much more consumer focused? How much of a risk, or how much do they fear higher oil prices for longer? Or is it something they're starting to look past?
In short, it's something that people are starting to look past. There is not that much concern. I think what we've been hearing with even a bunch of investor meetings this week is a lot of investors are underweight on consumer discretionary. Again, you go back to that March period, everyone downsized their consumer exposure, and people want to get to at least to an equal weight position now. And so they're looking for new names, and they're looking for names that have some data, that like a Somni Group or something like that there that sells mattresses. To talk around rates, Michael, you got this great chart that looks at the cycle of the 10-year yield over the last 3 or 4 years. And we go in these 6-month cycles where the rate's coming down, then the rate goes back up. And so I think you're right. It was May 19th where the 10-year peaked. And that doesn't go down a straight line, but we're 2 months into what could be a declining rate period for what normally lasts 4 to 6 months. So there's definitely, I've shown this chart to others. There's some receptivity that, yeah, you're probably right. Oil's coming down. CPI was favorable. The idea that the 10-year might continue to come in, I think is, I don't know, it feels like sort of a majority position. People are willing to look past what's happening in the Middle East and want to be bullish on the consumer right now. And also, I just think it also comes into the data that people see. There's a lot of credit card data, third-party data out there to assess spending, and even our own survey work that I was mentioning earlier. And it's not that every company is doing well, but on average, you're seeing some decent spending trends. And last comment I'll just make from even the banks earlier this week, all the major banks reported, and they all said positive things around consumer spending. So put all that together, and investors are looking past the Middle East situation right now.
Peter, so you also cover Home Depot and Lowe's, and you're talking about rates. What are you seeing on the housing front?
So as bullish as people feel on the consumer, I think they're a little more lukewarm on housing. Everyone's sort of housing curious. Like, I kind of want to own it if there's something that's changing, but it doesn't feel like it. And right now, it doesn't really feel like that much is changing. So we're seeing good spending trends on individual items for the home, right? If it's a TV or a new sofa or something like that. But you're seeing still very stagnant existing home sales. And we track home equity extraction dollars. That would be like cash out refi activity or HELOC activity. That is stagnated as well. So this idea around remodel and home improvement work doesn't really seem to be picking up very much. And that's the one where I think investors feel like that is the most rate sensitive. You need to see the 30-year mortgage rate come down and get closer to 6% or even lower to really kind of get housing going. So that's one area where I think, I don't know, they're not negative, but it's just they're not overly excited. But what they are excited about are some of these home-related items that much of this was heavily bought during COVID, went through a big COVID hangover, and you're starting to see some of these areas bounce back a little bit. And I mentioned a lot of those, whether appliances, grills, patio furniture, TVs, inside furniture, all that stuff is starting to show some solid improvement.
One of the big stories we've talked a lot about is how great earnings have been broadly for the overall market. And we a lot of times look at the sectors in aggregate. You having a better focus on the names and understanding of the industries, like where have you been seeing the same kind of earnings strength that has broadly lifted the overall market? And if so, where have you seen that from an equity perspective?
We've seen, well, we haven't started Q2 earnings season yet in the consumer. My space will kick off on this next week on Thursday with 2 companies. But I would say with Q1 that the earnings were largely in line. And we talk about that you got a little bit of that March, April slight slowdown because it was the news headlines every day where the gas prices are going up. And whether it was a company with a traditional quarter end, like at March, or some of the retailers on a fiscal calendar have April quarter end, there was a little bit of softening. So there wasn't I wouldn't say broad-based misses, but it was more kind of in line and maintain the guide. There's also, even on the tariff side, tariffs are maybe settling down a little bit, but the wraparound dynamics where the tariffs that went into play last year around, it was May to July, that still hasn't been annualized. And so there's still a lot of companies that have some gross margin pressure in their numbers as well.
Are you hearing from your companies in terms of any of those that are talking about rebates or have gotten rebates? I know there were quite a few last quarter. They didn't really quantify it, but they were expecting it. And from what I understand, analysts weren't including any quantitative assumption in their forward earnings estimates because the companies didn't provide it in their guidance. Is that something you expect to be a potential upside in Q2 earnings that you start to hear and some quantifiable numbers that they did get some refunds?
Yeah, like I said, one small company that reflected refunds in their Q1 numbers, but it seems like most companies will reflect it in Q2. And I think what we're hearing is that the refund dollars are slowly coming in, but they're coming in chunks. The accounting treatment, and I'm not an accountant, but the way it's been explained to me by its various CFOs, was that if there is certainty that you are going to be getting these payments, even if they haven't fully come in, that you can then reflect them, and you should reflect them in your numbers. So I think you'll see a lot of refunds show up in Q2. Analysts have not put that in their numbers. And frankly, it's largely going to get stripped out as a one-time item. So it will get reported in GAAP numbers, and then people will strip it out with non-GAAP. The companies that have reported thus far, since the smaller cap ones, the stocks haven't acted well on it. So it wasn't like a positive catalyst. I think what will be interesting is it is cash. And so what do companies plan to do with that cash? And so a lot of companies don't want to really show their hand. So we'll see. But I think you could see a little bit of price investment. Walmart made that announcement last week that they were going to start investing in grocery pricing. My sense is that is because they are getting tariff refunds. And then other companies have spoken to more likely to be using the cash for buybacks. So that's more the catalyst, and it's more maybe a longer tail back half catalyst rather than a one-time earnings beat that then will just have to be lapped next year. So that's why myself and others will very likely strip it out.
How about potential upsides from AI? We recently did a study looking at Q1 earnings reports of the S&P 1500, and 505 companies, so about a third of the companies, said they're using AI, but only 50 said they're actually making money from them. One of those, or actually two of those, are names you cover, Lowe's and Home Depot. They're AI assistants, which have helped increase the rate of conversion to sales. What can you tell us from what you're hearing from companies, or what do you expect to hear? Is there any potential upside from there that could get investors to latch on and see some further efficiencies?
Those are two good examples with Home Depot and Lowe's. The way I would characterize it is, I think they're getting some benefits, but it's not enough to quantify or to invest behind right now. But it's great messaging from a company. You could say Home Depot, Lowe's, they have these handheld devices for their store associates. They've incorporated AI into it. So customer comes in and has a question, they can use that to help the customer.
So at least we get a little bit of customer support, perhaps. I'll take that. That's one of those, you always hear a story of people going into Home Depot and being like, I couldn't find anything and nobody could help me. I've had those experiences. So that's a positive.
Yeah, we all have. But it's not like Home Depot is going to get on their Q2 call and say, we saw an extra 10 to 15 basis points of expense leverage because of AI cost savings. But it's a good message. Just that I think every consumer company I follow wants to show how they are using AI, and will speak positively to it. But it all feels very early in terms of driving any meaningful benefit.
Peter, we've talked a lot about the consumer, and you've mentioned the K-shaped economy, and that has been this story that has been building and building over the last couple of years. And the bottom part of the K with tariffs and all of these things has been weak. Covering a lot of these names that do cater a bit more, focus a little bit more on the low-end consumer, what are the company's thoughts on what it would take to maybe turn that around, pause the pain? We're always talking about the upper part of the K. What are your thoughts on the bottom part?
Sure. Yeah. I think I said earlier, the bottom half had a tough first half of the year, but the indications we're picking up is that there's been some improvement over the last month as oil prices have rolled over. And so it's just a function of maybe there's less pressure at the fuel pump. But if you look at a lot of the companies, like in the dollar store specifically with Dollar Tree or Dollar General, I struggle to think of a time, having covered those for 15 years, where they talked about a great environment for their consumers. Their consumers always under a bit of financial pressure. But when you take a step back and you think about the backdrop here that we've been talking about earlier in this discussion, we have inflation seems come down. We're in a very good job market, which Nancy and Jake on the economic team continue to talk about with the CapEx cycle. Unemployment rate is slowly coming down. So I think you're probably in a scenario where we could start to see some real wage growth later this year. In other words, wages outpacing inflation. And I think that's an ideal backdrop for lower income that has been under pressure. So I can tell you, even with meeting with a lot of investors, there's a lot of sort of interest and enthusiasm around the dollar stores right now. They've had a tough first half of the year. Probably the interest is a little bit more on the hedge fund side. That's interesting. Maybe there's a 3 to 6 month play here. I think some of the longer term long only money is still a little bit hesitant on the dollar stores and what's their longer term position in the broader retail landscape. But no doubt it feels like the backdrop for lower income could be a tale of halves here. Challenged first half and much better second half. One name we like a lot in that space would be Ollie's, OLLI. They have a portion of their sales that are lower income, but this is the stock trading at an all-time low valuation. They're a closeout player with a great niche. So that's one that jumps out to us that's been beat up a lot on this low income backdrop.
Would you think that the biggest surprise in the consumer space could be the low end consumer? Or is there something that you think could be the biggest surprise in the consumer space this year?
I think low income is on a short list of potential surprises. Like I said, I think everyone's like housing curious, and I'm not gonna forecast where rates are going because that's not what I do, and no one should believe what I say anyway. But if we are in a position where, like January, February, which we saw the 10-year continue to come down, and the 30-year mortgage rate actually went from 6.5 to slightly below 6. It was below 6 for about a week, but you saw really good performance with the housing complex stocks, and specifically like Home Depot, Lowe's. So maybe that's a good, maybe one or the other in the short list. I think the bigger surprise could be, yes, lower income, and we'll see on housing and what the rate backdrop looks.
Ironically, you think about consumer, you think about spending, you think about employment. The make or break for a lot of the stocks you're talking about could just simply be at the end of the year, did the Fed raise rates? If they didn't, those stocks have probably had a great second half. If the Fed did have to raise rates 2 or 3 times, I would imagine those are going to be names that are going to likely struggle, just from maybe not fundamentally as much, but certainly could be a backdrop if rates move higher from here. That's going to be a tough environment for their multiples to not compress. Any pushback to that?
None, but it's even, I think, might be done a good job of differentiating between Fed speak and market speak, but the Fed speak is important. And so if there is concern with what the Fed is saying that rates could be going higher, we see a lot of interest rate sensitivity in these housing names. Well, the rates aren't even moving, but it's just the overall sentiment on the street. You're absolutely right that what the Fed does over the coming months will have a big impact on the stock performance for a lot of the home improvement names.
I think you're going to have to insert a line item in your price target for Warsh's tone. It could be a plus or minus 5% tweak to your price target models. This was great. So I want to wrap up. You, as you mentioned, earnings for your companies are coming up. What are the 2 names where, one, you expect to hear some positive surprises, and what's a name that you're a little more concerned about coming into earnings?
Yeah, we were out today with the furniture retailer survey, and we saw a very good quarter for furniture sales. And so we've raised our numbers on Wayfair. So we're almost street high for the second quarter. Our survey has a 0.85 correlation to Wayfair sales. Ironically, we're doing brick and mortar retailers versus Wayfair's online sales. But it's furniture, it's an overall demand trend. So the demand trend's good. We like the potential upside for Wayfair, not only for Q2, but also I think there's some momentum in the space. So that's continuing in Q3. We've written that Wayfair is starting to pursue aggressive store opening strategy. Visited the store in Chicago this week. It's beautiful, big, it's beautiful. I think this is a really interesting emerging driver for Wayfair. So that's one for upside to numbers for Q2 and the back half of the year. That's interesting. The one that we've been a bit more concerned on, we've already lowered numbers, would be Tractor Supply. And they've already had a pretty tough year, but there's a really just confluence of headwinds on their business right now, and go through them quickly. We do see evidence that the U.S. dog population is now declining. Tractor Supply customers generally have larger dogs. Larger dogs have shorter lifespans. So there's an early indicator on this sort of dog population weakness. We're also in a bit more of a drought condition this summer than last summer. Last summer, we had a lot of rain. It was a very late summer. So you had this extended growing season in July and August. Very different this year. It's hot, it's dry. So you've got a shorter lawn and garden season going on. And then one other little sort of, I'll say funny nuance, but remember last year we had an egg shortage, and so they saw huge egg inflation. So last year we called it the year of the backyard chicken. The backyard chickens were white hot last year. This huge sales driver for Tractor Supply. egg prices have come way down. And so we're seeing evidence in our farm and ranch survey work that that chicken category, which is a nice category for tractors, is also now declining. Like I say, confluence of headwinds on what's a great long-term growth story, but they're in a little bit of a tough spot that's unfortunately out of their control right now.
All right, Peter, thank you very much for joining the podcast again. Really curious to hear from you after earnings season. Maybe we'll have you back on in a few months and check on how things have evolved.
All right. Thank you, Michael, Stephen.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.